that initial example of the mistake that I made in terms of the business owner not visualizing that the business and the real estate can be sold separately, really what that touches on is this probably the most important theme of all the remaining four, which is mindset. How does the business owner think about real estate and their business? So all too commonly, I see them kind of thinking that the real estate is an asset of the business. And you'll even see it on their balance sheet sometimes. And it's held in the same LLC, or it's just held in the business owner's individual name. Like they're not viewed as through the lens of like an operating company and a real estate company, or an opco and a propco. And that's really the next best step for working with a business owner, is help them visualize that, yeah, you own both these things and the real estate supports the business in a dramatic way, but they are separate things that you need. If you can mentally compartmentalize them as two separate things, now you can understand how you can value them separately, how you can leverage them separately, how you can de-risk them separately. So that's the biggest one, is mindset.
Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can get more all the way to help MVPs. My name is Brett Swartz. Each and every episode, we're joined by the world's top entrepreneurs, millionaires, or billionaires, and they share their secrets, wisdom, and insights with us so we can all level up and make a bigger impact. And today's guest is no exception. He's out of North Carolina. And he's got a passion and an influence over with people who are exiting businesses and have commercial real estate, and really bridging the gap between the two, because it really seems to be a disjointed type of space where you have like M&A advisors and business brokers, and then you have commercial real estate brokers. But how do you combine the two? And there's so much that's dropped in value and or strategy if you don't have someone like our next guest. In fact, he is a result-oriented with a proven track record of achievement and experience in commercial real estate, corporate exit strategy, structured finance, reinsurance structuring, and civil engineering. His focus is on building trusted partnerships, creating strong relationships, and developing high-performing teams. And he is a certified as an exit planning advisor, and so much more. Please welcome to the show with me, Jason Bush. Jason, how are we doing?
Brett, I'm doing great. Thanks. That was more introduction than I deserved. Really what that means. I've dabbled in I'm 56 years old, and I've dabbled in a lot of things, right? It's kind of like the cumulative effect of, chasing various different opportunities over our careers.
I couldn't agree more. I mean, it's like a Swiss Army knife. Like, you might have started out with just like the little knife part of it, but then you go more, and you get those little scissors that pop out, and then you get a little more, and then you can pull out the screwdriver. I think that's part of the ability to add value is when you can see it from different angles, right? The problem from different angles, and you solved it from different angles, right? As a broker, and then on different structuring and different, then all of a sudden, when you come into a situation, you're not just looking at like a nail and only think you have a hammer, right? We were just talking before that most people think that 1031 exchange is really the only end all be all for exits. And that's all they know is, 1031 is the hammer, the nail is investment real estate, and they hit it, right? That's all they know, right? But there's so much more to that. So before we get started, though, I want to start with a little bit about Jason growing up and or your experience with work. What do you feel like are your one or two superpowers that you have, or strengths that help you and bless people today?
Yeah, I'm an entrepreneurial quant. Is probably the strongest running theme over those various misadventures in my career. I was a civil engineer originally, and I was a PE in New York. Grew up in the Adirondacks, upstate New York. So as a result, I still love the winter. Even though I live in the Carolinas, like, I like to snowboard as much as I can in all sorts of places in the world. And so, that quantitative background and with an entrepreneurial spirit has kind of led me on various paths, be it as an investor in commercial real estate, as a niche player in the reinsurance industry, as a strategic broker or an advisor for either real estate or business growth. Like, lots of different things that have kind of accumulated to where we are today, which is really providing, strategic advisory for business owners and the relationship that exists between their business and the real estate their business occupies.
I love it. And which is perfect for the talk today, which is basically commercial real estate and business exits, and basically the lost opportunity that, folks are having every single day because they don't have someone like a Jason Bush helping with that. And, or you're the advisor on one or the other, and you want to bring into your team to help your clients, to help you can grow your business even more. So let's dive right into that. So what would you say is the biggest, mistake that either business brokers or commercial real estate brokers and or the owners of these assets that are selling, they're missing with the combination of selling both or one or the other?
Yeah, so your hammer and nail analogy is a really apt one, right? We hear it all the time, but unfortunately, it continues to ring true over and over again. One of the things that caused me to become a CEPA, Certified Exit Planning Advisor, was that one of my previous business ventures was really working with brands and working with business owners, helping them grow. And my growth solutions were commonly applied towards real estate centric type of businesses. So as small business owners or private equity brands that were looking to grow. And one of the things that happened over that period of time of working with PE is we ended up becoming a buy-side advisor for them. So we were sourcing businesses for them to acquire. And I've done a lot of it over the last 5-6 years. But here's a common mistake that I saw that really led me to create my new practice, which is commercial real estate strategic advisory, is that I'd be representing a buyer, or my firm would be representing the buyer, which was a private equity firm. And we were acquiring Main Street level businesses. They were purchase prices in the 3 to 25 million range. And private equity, generally by definition, does not want to acquire real estate. But the seller of this business would commonly own the real estate and would consider a sale of the real estate in order to fit their own definition of what a full exit looks like, the sale of both the business and the real estate. And here's where the mistakes would start to kick in, is that, the M&A advisor that was representing the seller, as the M&A advisor, they were swinging that hammer, right? And the nail was the business asset. And so all their analytical rigor, all their methodology would be applied to the preparation and the sale of the business asset. Well, when that seller would bring the real estate along, here's where the challenges would begin. And now it doesn't happen all the time, right? There's amazing M&A brokers out there that know how to deal with real estate, but unfortunately there's some that don't. And that M&A advisor was often ill prepared to deal with the real estate asset from a valuation standpoint, from a marketing standpoint, or from a packaging of both the business and the real estate asset for sale. And as such, the real estate asset would not receive the same level of analytical rigor and methodology that the business did, often resulting in an undervalued asset that would be packaged and delivered for sale. Oftentimes, it's significant discounts, and it was often due to because either the M&A advisor viewed it as an afterthought or viewed the inclusion of the real estate into the business sale as kind of a deal sweetener. But it was also the fault of the seller by not understanding that these are separately valued assets that can be valued, sold, transacted on their own merits. They don't have to be included in a package. And so from time to time, it would make sense. I'd be able to convince my private equity buyer who did not want to buy real estate to buy it because they were getting a screaming deal on it. They would go ahead and triple net lease it to themselves as the operator. We'd flip it back out in the investor market. And, by the time they completed the full recycling of their capital, they ended up cutting their exit multiple that they paid for the business maybe in half, right? And so that should never happen, right? Because it led to a suboptimal outcome for that seller. And it made me realize, like, in my small corner of the M&A universe, right, where I've done maybe 200 deals over my life, like, that happened in my little world more than it should have. How many other times is it happening elsewhere? And so that's what really led me to become a Certified Exit Planning Advisor, a CEPA, and then to also start to craft a practice around working with that business owner, working with that advisory team to keep that suboptimal outcome from ever happening again. Now, there's a lot of steps that have to happen in order to make that occur. But that was really kind of recognizing that level of mistake was really what kind of put me in this new path.
Excellent. Speaking of Jason Bush, everybody, and he's focusing on helping you, the M&A advisor and or the commercial real estate broker and or just the owner who's listening to this, the business owner, real estate owner, understand the value that needs to be on both sides and the rigor that needs to be on both sides of underwriting the asset of your real estate and the asset of your business and not getting them one undervalued versus the other, right? And looking for strategies. So let's break down an example. Let's bring this to life, right? Mm-hmm. So you have an owner user of a property, or and he's maybe looking to retire to sell the business, right? Walk us through like a live deal or a deal. It's just a good case study that can bring this to life to make sure that these are the questions they want to be asking, and these are the types of strategies they want to be thinking about.
Yeah. So my role, Brett, is one that the earlier you bring me in, the better. Right. This is not a transactional focus, right? If I get brought in at transactional time, it limits what we can do in terms of improving the situation. Ideally, I want to be brought in 5 years before an owner is selling, right? The sooner the better, right? And your example where you've got a business owner that also owns the real estate, my initial engagement with that business owner is I'm trying to assess what is the situation? What is I call it the real estate scenario. And I purposely call it that because there's a million different variations of what a real estate scenario can mean, given the type of business that operates, the type of real estate asset class it utilizes, what market in the country are they located in, what's the competitive environment of the business that they're in, what are their lease terms, who are their landlord. You ask all these questions and suddenly you get all these various permutations. This business scenario is sort of like a snowflake at this stage. They're all unique. And really what I'm trying to do is, once I understand the scenario, I'm trying to assess where does it live if you can envision a spectrum between totally buttoned up, being the good end of the spectrum, and hot mess being at the other end. And generally, there's a very normal distribution curve between those two ends of the spectrum. I see just as few totally buttoned up scenarios as I do hot messes. But unfortunately, I've seen both. Generally, they're in the middle, which means they're not a wreck, but there's room for improvement, right? And so my initial role with them is to take them from wherever they are and close that gap analysis to get them from wherever they are to more buttoned up. And the way I define buttoned up is that once you're buttoned up, you've created transactional flexibility for yourself. You can now utilize both the business asset and the real estate asset if you want to as levers to fund growth. Right? This is not an exit only conversation. So you can use those assets to fund growth. If they're in maintenance mode, now if they're buttoned up, they just got one less thing to worry about, which is nice. Or if they truly are contemplating an exit, now we can help that business owner visualize the various permutations of what an exit can mean when you have a properly managed business asset and independently valued business asset to sell, and then a properly managed and properly valued real estate asset to sell, right? You can sell them independently, you can sell them together, you can sell them to the same buyer, you can sell them to different buyers, or you may elect to not sell the real estate and use it for income purposes. But if you're going to do that, let's make sure we're receiving the maximum amount of income you can, and also maximizing the valuation of the real estate. So that's at a high level. That's what we do, and the details really depend on what's their scenario, what's their situation, what needs to be worked on, what kind of timeline are we dealing with, as well as how does the real estate solution compare to other maybe more pressing needs in their world.
Got it. Okay. So it really sounds like it's A, getting in early with you, right? And then B, understanding that it's not always about an exit, at least right away, right? And it could be about growth and acquiring. It could be about maintenance and getting things buttoned up. And then eventually figuring out, the most strategic way to exit both the business and the real estate. Is that a fair summary so far?
Yes.
Okay. So yeah, now let's give an example. Do you have like a deal? Either it can be a live deal, can one you closed recently, whatever, right? It comes to life to kind of bring these thoughts to life here.
Yeah. So I'll get to the live example, but I want to take you kind of through the stair step of stuff.
No problem.
No matter what the scenario is and what type of business owner you're working with, generally I see there's 5 themes that really are almost universal in terms of the the scope of work and getting them buttoned up. The first one really only applies when the business owner leases real estate, right? Which is understanding their existing transaction, meaning their lease, right? It's really, really common business owners don't recall what they've signed. They can tell you when's the rent due, how much it is, and what my original lease term was, right? But they don't think through all the other components of a lease that might impact their ability to sell the business. Assignability clauses, options to purchase, that kind of stuff. So that first theme really applies best when they're just leasing the real estate. Where the fun stuff happens is when the business owner also owns the real estate. That initial example of the mistake that I made in terms of the business owner not visualizing that the business and the real estate can be sold separately, really what that touches on is this probably the most important theme of all the remaining four, which is mindset. How does the business owner think about real estate and their business? So all too commonly, I see them kind of thinking that the real estate is an asset of the business. And you'll even see it on their balance sheet sometimes. And it's held in the same LLC, or it's just held in the business owner's individual name. Like they're not viewed as through the lens of like an operating company and a real estate company, or an opco and a propco. And that's really the next best step for working with a business owner, is help them visualize that, yeah, you own both these things and the real estate supports the business in a dramatic way, but they are separate things that you need. If you can mentally compartmentalize them as two separate things, now you can understand how you can value them separately, how you can leverage them separately, how you can de-risk them separately. So that's the biggest one, is mindset.
Okay, that makes sense. Yeah, and then and just structurally too, right? Just getting opco, propco, and make sure they are separate, and then separate set of books, separate set of entities, separate set of risk, because they are really two different distinct assets, and that makes sense. Okay, so you talked about the leasing versus in the mindset, and what's the next one of the five?
Yeah, so you touched on it already with legal structuring, right? Once you visualize them as separate things, make it so, right? Have a separate legal entity for the business, have a separate legal entity for the real estate. Generally, I'm somewhat agnostic as to what those entities should be, right? Because everyone's estate planning and tax situations are different. The only thing that I like to see is I don't ever like to see real estate held in an escrow, just because it limits the benefits of all the amazing work that you do of being fully passed on to the individual.
Okay, so, got it. Yeah.
Mm-hmm. Legal structuring. Once you've got them visualized as two separate legal entities, now you have to formalize that relationship via a brand new lease structure between opco and propco, and working them through the fact that ideally those need to be done at market rates and terms, such that you create transactional flexibility and maximize the value of the real estate asset. Think through, I'm trying to get them comfortable with the idea that you may end up selling the real estate to an investor as a triple net product, right? So let's structure a lease. Should you need to sell this thing tomorrow, right? So that's the fourth step is the legal structure between the two via a lease. And the last one, which connects to your world, is transactional support. Like at some point, and I purposely call it transactional support, I don't call it brokerage. Transactional support means, preparing to sell, not selling, as well as mitigating the results of selling. And so it's much more than just selling real estate or selling the business, right? You got to take a very comprehensive approach when you're anticipating selling something. And so the last thing is really that transactional support. And for me, my role is I want to put them, the business owner or the seller, in touch with the best resources possible to increase their probability of success, right? So if they're just selling real estate, and it's in a market in which or an asset class that I've never personally done brokerage, I can source, vet, and introduce to that business owner, like, here's the best two brokerage resources for your scenario in this particular market. If they're selling the business, I can do the same thing regarding the M&A advisor. And then if they're, want to manage their tax implications as a result of the sale, I can introduce them to somebody like you, who is a master at all the things that you do, right? And so that's why that last theme is transactional support, and it's not brokerage, right? It's caused by a brokerage style event, but really it's larger than that.
I just spot on there. I just think that too many times, back to the hammer and the nail, it's not just one dimensional. It's really three dimensional. I love the way you put it. There's preparing to sell. There's number two, selling. And number three, mitigating the results of selling. And I think too often, if you don't build a team of experts and you're just relying on either just the one CPA who only knows about the 1031 exchange, or just the one M&A advisor who doesn't really know about real estate, and he's just really good at getting bidders to bid up, but he hasn't helped to prepare the sale to get a higher EBITDA in order to get a higher price, right? And then of course the capital gains tax and estate tax parts of it. I mean, it's 20 to 50% of the proceeds are going to be crushed by tax and depreciation recapture, and or estate tax after if it's big enough. And so, you're right. It's like you got to see in 3D. We call it tax flow, cash flow, and debt flow is another way of thinking about investing. And if you don't have that kind of mindset and that kind of advisor to help you see that, it's easy to get caught and not be in a great spot for those three things. Okay, that's excellent. Wow, that really opens up what you do. Was there one other one, or was that the fifth one?
That was the fifth one.
Okay, cool, excellent. So now maybe if you're ready, break down maybe an example and the case study, and just kind of bring this thing to life. And otherwise, keep going.
Yeah, so I ran into a real life example the other day, and I kind of call it. I branded it. I think I made a LinkedIn post about it where I called it dimes over dollars, where the seller in this scenario, this is a real life example, owned both the business and the real estate asset, and was hyper focused on selling the business first. They wanted to retain the real estate and engage with an M&A advisor, and they got the real estate sold. And unfortunately, this 3D view didn't happen. Where, from a total enterprise value standpoint, in this business owner's, if you think through the business owner's net worth, 90% of his enterprise value is in the real estate, and 10% is in the business. So, from a total exit strategy perspective, it should change your approach, your strategic approach, right? The business asset is secondary. The primary asset is the real estate. Unfortunately, in this scenario, they were hyper focused on selling the real estate or the business first. And it was sold, and it was a marginally profitable business, and he got it sold. And the reason that it was marginally profitable is that the business owner never had the proper mindset and never realized that he had two separate, distinct assets, the real estate and the business asset. And so when that happens, commonly what you see is the business owner essentially underleases the property to the business. They transfer just enough cash from the business to cover the obligations of the real estate entity, to cover debt and insurance and taxes and maintenance, right? Which translates into, it's a severely under market lease. And in this case, while selling the business, nobody did an add back or an adjustment to rental and occupancy costs. And so the business probably was sold for way more than it was worth, because if you'd done a proper add back, that EBITDA might have trended towards zero or negative, right? It was a business that probably should have been liquidated versus sold. And then here's where the big error happened, is that the business seller continued to utilize the same set of rates and terms with the business buyer, who now locked up and leased his 25,000 square foot warehouse for 5 years. And the business owner, or now only the real estate owner, he reached out to me and said, Jason, I sold my business about a year ago. Now I want to sell the real estate. Can I? Like, nope. Unfortunately, I mean, you can, but you're going to get about a quarter of what it's actually worth on the open market, because you structured a lease and a long-term lease at severely under market rates and terms to your tenant, who is going to maintain occupancy during the rest of that period. And no investor is going to pay you for that building now. They're not going to pay you for what it theoretically is worth. And so from a strategic standpoint, like, this is just so full of errors that that owner is unable to complete their exit now for another 4 to 5 years, pending the tendency of that tenant. And, who knows what happens in the next 4 to 5 years regarding, that facility, the building, his health, like all the 5D type of events, right? You just created 4+ years worth of timeline to have, nature have its role on your exit strategy, right? So many errors were made in this situation that, unfortunately, post transaction you can't correct it.
Wow. I mean, that is, you paint the picture really well. Make sure I caught all that. So it sounds like for whatever reason, this owner wanted to sell the business first, right? So he focuses like a laser on that. Perhaps it's taking up the most amount of his time or his energy or whatever it might be. He wants to sell that, but he's not stopping slow enough to say, what is the business actually worth versus the business versus the real estate? And if 90% is the real estate, then wow, you should probably focus and not do anything until you say, why is it worth so much more, and what could affect that worth long term? And instead, the buyer of the business, saw this as an opportunity to lock up a lease, right, for a longer term period. And I can't imagine he didn't know that it was below market rents, right? And then say, well, I'll pay you a premium for the business, quite well knowing that it's, that's pennies, right, for him. Yeah, it's a great trade. He's like, I'll pay you. And so the seller's getting caught in like, oh, I'm getting a premium for my business. But really the strategic play is that he's paying chess versus checkers. And he's going, yeah, I'll pay for more than that because I'm getting 90% value over here. And fast forward, he realized, go ahead.
That M&A advisor got compensated for selling the business when that wasn't the action, right? His hammer, it was that hammer and a nail analogy again, right? Yeah. That M&A advisor should, if you were a good advisor, you would have adjusted course or recommended adjusting course, right? Because certainly we're not acting as a fiduciary in that example.
100%, and that's just plain. That's pretty clear. I'm curious, what was the size of the real estate? I'm just curious, what was the value?
It's a 25,000 square foot warehouse that should be triple netted at around $12 a foot. So it's a $3.5 million asset. Yeah. That's now, because of its rent terms, is probably 30% of that.
Yeah, exactly. So that's real life, real dollars. Speaking with Jason Bush, everybody, you can learn more about him. He's a CPA and MBA. Okay, that was really good. Now, we touched a little bit here too. I think it's the same analogy for like exiting and capital gains tax, right? I think that also, on the other side of commercial real estate brokers, they get caught in a situation where there's like, well, let me just, sell that property and let's just 1031 it and let's put it into, a single asset in a single location with a single tenant. Although it's triple net and it's sexy on the sense of like, hey, no toilets, no trash, their insurance, they're covering all of that. But the tenant may or may not be as strong, and or they may even have a decent lease, but then they push the when push comes to shove in 2 years, they're like, you know what, we either don't want to renew, or I just saw Apple go out on one of the biggest malls. This is happened over the weekend. They're announcing they're no longer going to be a tenant there, and this mall is trying to sell. And, and they're like, well, we're not going to be a tenant there anymore. And they're like pleading with him to stay because that's such an anchor tenant for a mall. People come to an Apple store and then they're all the ancillary, buying, and so just thinking of concepts like that. And to me, it's dropping the ball for the commercial broker, right? And or the M&A advisor when it's only 1031 exchange, right? Yep. And so talk a little bit about that and just the importance of diversification and flexibility with the exit rather than just only do the 1031.
Yeah, so there's a education problem or a knowledge problem regarding understanding what your alternatives are. There is a bit of a hammer and nail problem here as well in terms of, within the brokerage community, right? You love to consider putting someone in a 1031 exchange, right? Because you're going to have two transactions now as opposed to one. Unfortunately, that the education problem exists within the financial and wealth advisory community too. Like generally, they don't have the level of understanding in commercial real estate, right? And they can't know everything, right? But they do know 1031s exist. So I get asked all the time, like, Jason, do you do 1031 exchanges? I'm like, yes. However, before we even engage in that path, let's ask some better questions of the owner that you're representing, right? it's really weird how often we run into the scenario like people actually don't understand how to calculate their gain. Like, do you even have a taxable event that needs to be managed, right? So it's understanding like, all right, is the juice worth the squeeze in terms of do we even need to bother with a maintenance process here? Let's assume that we do, right? But understanding that gain, it's such a fundamental concept, but that's how the math starts in this, right? In the world that we work in. So there's that. Then also, what's the seller's liquidity needs? The idea of rolling 100% of proceeds into a 1031 exchange sounds great, but it only works if the seller doesn't have a liquidity problem, right? If they need to take some of those proceeds, I'd love to manage your gains, but dude, you need your cash, right? And then also that's the larger tax picture that often isn't explored. Did they harvest losses somewhere else? Do they have other commercial real estate and they just completed a cost segregation study and achieved bonus depreciation on 80% of this other asset that they own that they haven't, that's going to hit this year, right? They may have already harvested their natural offset to their capital gains, and so you may not have to seek out a second transaction, right? So I like to ask all those questions first, just to understand, again, like, what are we dealing with here? What's the scenario before I start even trying to recommend what solutions could be for their situation? And then all too often, like 1031s or DSTs are thought of as, oh, we're selling real estate, therefore I need to want to use one of these two options, right? And they ignore all the 453 type of solutions that are applicable to all asset classes, right? And I've got you smiling, right? Because that's where you step in, right? You're like, this is what I do, man. And so as part of that transactional support role, like if they believe they'd like to manage the impact of their capital gains, I like to present them, once I understand what their situation is and their needs, not only the 1031, but the DST, meaning the Delaware Statutory Trust, and then the 453 options via installment sales trust, or deferred sales trust, like all those different iterations. Like there's so many, in your world, I'm not even going to try to explain it, right? But there's so many different iterations of what those 453B type applications are. Like how do you recommend a solution until you ask those basic questions up front? Like, what are you trying to accomplish? And so therefore, here's some potential alternatives. But most importantly, I know what my lane is and I know what it's not. And so when I run into that situation, I'm like, hey, Brett, I got one for you. You got to talk. Yeah.
Appreciate that. Yeah. If people want to learn more, go to capitalgainstaxers.com about your options. And so, and by the way, sometimes it is a 1031, it is a Delaware State Trust, it is a deferred sales trust, right? It is some bonus depreciation, some cost seg. It's a mix. Like it doesn't necessarily be a one size fits all. One thing we'll remind everybody that the 1031 exchange and the Delaware Statutory Trust, which is another form of 1031 exchange, that only works for investment real estate now. Yep. So all of the business sales, all of the Bitcoin sales or stock sales or high-end primary homes does not work in the 1031 world. Right. But the 453A, and we have another one that's kind of a little bit outside of that works for public stock and eliminates the state tax. It does, and so you got to know what you're up against the tax. You got to know what strategy works for your type of exit. By the way, if you have debt over basis, that's a big piece of it too. We can't defer debt over basis. You basically already have received it. It's considered a boot. 1031 can continue to kick the can down the road for that. But yeah, you want to know that you're walking and solving problems in 3D versus 1D, and realize that if your advisor is not vetted and or has experience with multiple exit strategies, they may not be the best only advisor for that transaction. That's when you want to bring in a Jason, bring in me to continue to build a team to help you with this exit, so that you're not surprised like this last client, or last person you talked about that got caught selling too soon his business and jumping over dimes to pick up pennies. Jason, we are running out of time. You ready for the lightning round?
Yeah. I didn't know we were going to have a lightning round, so yes, let's go.
All right. Knowing what you know now, if you could go back to your 20-year-old self, what's the one gold nugget make sure to tell yourself to do?
I'd invest in real estate much sooner than I did. also to get comfortable utilizing debt as a tool and not look at it through a negative lens. I was, in my early years, I was pretty hyper conservative, financially. So yeah, those two were the big ones.
Excellent. Number one book you recommended the most the past year?
Oh God, there's so many that I've read recently. Mike Garrison is a fellow SEPA. I'll give him a big plug. He has got a very cool book that I just finished reading, all about establishing a great referral network and the power of referrals. The title of the book's called "Can I Borrow Your Car?"
Cool.
Which makes amazing sense as a theme, right? That wonderful book, all about referral strategy, the benefits for both parties. Love it.
Fantastic. Next question. What are you most curious about right now?
My son just accepted a job in Phoenix, and so he's moving from Rochester, New York to Phoenix, and so I'm really curious as to what rental studio apartment rentals in downtown Phoenix look like.
Yeah.
Personally, I am attempting to do a heliboarding trip in Argentina sometime over the next year or two, and so I'm starting to research that a bit. So that's a non-professional curiosity in both of those areas.
Very cool. Next question. Number one leadership quote or theme that you strive to live by?
E-Myth Revisited, when I first read it, 20 years ago, really introduced me to the concept, again, coming from an engineering background, right? Never thought about any of this stuff, of lagging indicators versus leading indicators, and how too often we like to manage results, the lagging indicator, as opposed to measuring and tracking leading results or factors. And so that one remains true since the day I read it, right? Focus on those leading indicators versus lagging.
Fantastic. And a very last question, after all your success helping all the people you help exit and plan and be great stewards with their wealth, what's the best way that you help to help yourself or help others to continue to practice a mindset of stewardship over ownership?
Yeah, be accepting of the fact that we know lots of things, very little about lots of things, right? Recognize that is our situation, right? But be curious enough, really take a curiosity-based mindset when you're working with your clients. Just ask 100 questions. And then when those are done, ask 100 more, right? If you take a curiosity-based mindset to our engagements, either with business owners or with each other, we will find a way to work together and be resources for each other, right? And then it's really just about understanding what's the problem that needs to be solved and being humble enough to recognize, like, okay, I can't solve this one, but I know I can bring in a suite of resources that can.
Jason Bush, it's been more than a pleasure having the show. I want to thank you for sharing your wisdom, your insight with us, giving us practical ways to look at deals for commercial real estate business and build a team and have clarity on values and the importance of that for both asset types. I want to encourage you to keep using the gifts you give to help and bless people. For our listeners who want to get in touch with you, one last time, what's the best place for them to find you?
Yeah, so my firm is Commercial Real Estate Strategic Advisory. I am extremely active on LinkedIn. I'm a certified exit planning advisor, so you can find me through the Exit Planning Institute. Send me an email, give me a call. I'm easy to find if you look me up through LinkedIn.
Awesome. Thank you, Jason. I also want to thank all of our listeners and our viewers for watching or listening to another episode of the Build to Billions podcast. And also we're streaming on Capital Gains Tax Solutions podcast and YouTube channels. And we're on this journey with you to scale from millions to billions. So we give more all the way to help MVPs, the most vulnerable people. I want to encourage you to listen to this, to share it with somebody, and to take action. Of course, you have a large exit coming up, business or real estate. Reach out to Jason and he'll give you some insights and help you with this. Be early. And if you have a large capital gains or estate tax challenge coming up, reach out to us by going to capitalgainstaxsolutions.com. Appreciate everyone listening and watching out there, and we'll talk to you again real soon. Bye now.